Hey there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. I'm here to bring you trading levels in the major market indexes for the new week that's just starting today, July 22nd, 2024. We'll take a look at the S&P 500, the Nasdaq, the Russell 2000, and we'll also take a look at the long-term bonds as represented by the TLT ETF. Before I get going here, the usual disclaimer, everything I'm about to present to you is for educational and information purposes only. Precision Trading Labs, we are neither money managers nor financial advisors. So let's take a look at the indexes here. We're taking a look at the SPY here on the daily chart. So in fact, we can see that earlier last week, we actually hit another all-time high on Tuesday, and then ever since Tuesday, the market gave back about 2.5% or so. So that's where we are now. If you notice this region right here, this is this region of consolidation that was the lead-in to that run up to the all-time high. You'll notice that right here, price had consolidated and was kind of getting shuffled back and forth for the better part of about 6 or 7 trading days, and so it was trading within this very narrow range. And if we think of the shares that are acquired by buyers, we can kind of call that demand, okay? And if you think of the shares that are offered up by willing sellers, we think of that as supply. And so within here, the supply and demand for shares is basically in balance. It's an equilibrium. And then right here, that equilibrium, that balance is broken. And there is essentially an exhaustion of sellers. No one is willing to sell here anymore. And that's where you have that run up of price. And so what's left in the wake, where supply and demand were in balance, right here when price rockets out of there, there's no longer any supply, only demand. Consequently, we call this a demand zone right here. Okay. Above here, above current price, it's the exact opposite narrative here. This is an exhaustion of sellers, an exhaustion of buyers here. And so price hit an equilibrium for about a day or so, and then price dramatically dropped out of that. That exhaustion of buyers left in its wake only supply, but no demand. Okay. And so as a result, we think of that as a supply zone. Okay. And the way we trade is when price returns to a qualified demand zone or a qualified supply zone, that's the foundation for a trade for us. And so in the case of here, this is where we would express a bullish trade out of a demand zone, okay? Because we're expecting a good percentage of the time that we're going to see a repeat of this behavior here, because essentially there is untapped bullish buying pressure that's waiting to be tapped there. And so when price returns here, again, we can express a bullish trade. And so the way we could express a bullish trade, of course, is the most direct way, of course, would be simply to buy the SPY. Another way to do that, of course, would be to buy a call. And then if one wanted to collect premium, one could also sell a credit spread. And so one could sell a bull put vertical credit spread in order to then collect premium. So all of those would be ways to express a bullish trade when price returns to that demand zone. Okay, and of course above you do the exact opposite. You could short the stock, you could buy a put, and of course one could also collect premium up here by selling a bear call vertical credit spread. So same concepts, just turned on its head. So at any rate, right now, here's where we closed on Friday. In the pre-market, we're actually up about 0.5%. As we know, the presidential election, obviously that everything changed. Joe Biden has dropped out of the running there and is anointed Kamala Harris. We'll see what happens with that. So far, there seems to be a reasonable, a muted reaction, 0.5% or so, but there's no huge reaction in one direction or another to that news. So we'll obviously see how that plays out this week. So at any rate, right here is a demand zone for the SPY. Above there is a supply zone. So We're obviously right now we're about 1% above there, and we're about a little less than 2% from that supply zone. Okay, and then down below, if this level wouldn't hold, then we're about 3% above this region. So these are the key trading levels that we have here for the SPY. Okay, if we turn to the Qs, we'll see something relatively similar here. So right here, here again, here's that all-time high. Again, we ended up kind of dropping out of that. So we're sitting there about and we're actually sitting here about a little less than 3% now, because we're actually showing a pre-market move of about 1% or so. So we're probably a little less. We're a little less than 3% away from that here. So this would be an area where, again, we would express a bearish trade up here, and then this area around the 465 mark would be an area where we would express a bullish trade. One of the things that I do notice here, I wanted to point out here, particularly on the Qs, is if you notice we have the intersection of the 50-day simple moving average, and then we also have the daily lower default Bollinger Band here. Okay, and so if we notice this confluence of all of this stuff, kind of all in this region here, more often than not, when we have a quality supply, the demand zone like this, and then we have an indication that price is kind of very stretched to the downside, and then if there is a moving average, which essentially we can think of as a dynamic trend line, all of those things that sort of combine in that one area generally contribute to a higher probability trade. So we're kind of enthusiastic about this setup here if and when we get a pullback to that region there. So that's the story with the Qs. We'll take a look at the Russell 2000. Okay, and the Russell 2000 actually kind of unusual here. It actually kind of broke through its upper Bollinger Band, and then is actually now starting to head back down. This is a 52-week high for the Russell, but it's not an all-time high. So there is its 52-week high. So it got up there. It's now obviously down here. Here we actually have a 2-hour demand zone here. So there's no demand zone here on the daily chart. But if we actually flip over quickly to a 2-hour, we'll see right here. Notice right here we had a rally, price consolidated, and then rockets out of there on the next day there. So right in there, supply and demand were in balance here, and then right there was that sudden exhaustion of sellers. And so again, this is where we would look to express a bullish trade out of that region there. Okay, so that's the story with the Russell. So right there, a short distance above here, we have that region there, and then down below here, and this is obviously a further distance down, about 6.5% down or so. And this is if we go back to the daily chart here, we can see right there, there is an area of demand there. Price hops up there. Notice then we have that area of consolidation there, and then notice that gap and go. So right there, there's your exhaustion of sellers here. And so when price gets back here, this is where we would express a bullish trade. So that's at around the 203 mark. And in terms of how we would structure that trade, right here, here's our entry point, okay? And then right here, this is where we would place our stop. So we have the demand zone here. We place our stop a short distance below here. So we're giving it about an extra 50 cents or so below that, just to account for a little extra market volatility or variance there. So this is where we would place our stop. There's our entry point. So we can see that the range of that zone is approximately $4. So in fact, if somebody wanted to simply trade the IWM, and they wanted to also figure out what their position size would be, you could basically take your permitted risk per trade, and let's just say hypothetically you're going to allow yourself $100 worth of risk, or excuse me, let's say you were going to allow yourself $500 worth of risk. Okay, if it's a $4 range on the spread of the zone, that would give you permission to trade 125 shares. If you had $500 of risk, but the depth of your zone was $4 with the stop. Okay, and of course that assumes that you actually have the buying power to do that. But in terms of pure risk and reward, that's how we would figure that. Okay, so that's the story with the Russell. And then the last thing we'll take a look at is the TLT ETF. This is the ETF of the longer term bonds, 20-year duration and beyond. So it doesn't include the 10-year note, but goes 20-year and beyond here. So right here we can see that in the pre-market, that's also up about 0.5%. So in fact, we're actually up above here about 1% or so. So we would wait for a pullback here, and then this is where we would express a bullish trade on the TLT. Okay, and then if this level failed to hold, this one is now about a little over, let's say, 3.5% down. Once we factor in the 1.5% pre-market move here. So that's about where that would be. So that's at around the 90 mark here. And in terms of supply, this is an area right here. We can think of this up here as resistance, but it's really not fresh supply. And the reason we say that is because price came up there, really created a supply zone right here. But ever since then, now we've been back there. Price came back, it has been back there multiple times. So in fact, this is one could launch a trade from here, but it's lower probability because price has been back here a couple of times, and so as a result, some of the supply has been chewed up. So that's the narrative about that. So at any rate, thank you for the privilege of your time. This is Mitch Firestone, and I will see you next time. Take care. Bye-bye.